Stop what you're doing right now and listen to me very carefully because what I'm about to tell you is the difference between financial survival and complete wealth destruction. Today is Monday, January 26th, 2026, and at exactly 9:47 a.m. Eastern Standard Time this morning, silver broke through $110 per ounce for the first time in human history. And while that should be the headline on every financial news network in the world, what's actually more important is what happened immediately after that price was hit. Every single talking head on CNBC, every financial advisor at the major brokerages, every so-called expert who's been wrong about precious metals for the last decade started screaming the exact same message. Sell now, take your profits, silver is overbought, this is the top. And you know what happened? Exactly what I predicted would happen. Exactly what everyone who actually understands monetary history knew would happen. The price didn't crash. It didn't even pause. Silver blew through $110 like it wasn't even there and is currently trading at $112.50 as I record this, and it shows absolutely no signs of stopping. The velocity is increasing, the momentum is accelerating, and every single person who listened to those financial advisors and sold their silver this morning just made the most expensive mistake of their entire lives. Let me be absolutely crystal clear about something before we go any further. If someone is telling you to sell your silver right now, they are either catastrophically ignorant about what's actually happening in the global financial system, or they are deliberately trying to separate you from the only asset that's going to preserve your wealth through what's coming. There is no third option. The fundamentals that are driving this silver rally have not changed. In fact, they've gotten stronger in just the last 48 hours. And I'm going to walk you through exactly why 110 is not the top, why $200 is not the top, and why anyone telling you to sell right now is either a fool or a fraud. But first, I need you to understand the context of what happened this weekend while you were sleeping, while you were watching football, while you were living your normal life, because the world changed in ways that guarantee silver is going much, much higher. At 2:14 p.m. on Sunday afternoon, President Trump sent out a tweet that effectively declared war on the entire budget process in Washington, D.C. The message was short and devastating. Government shutdown in 6 days. The swamp is broke. No deal until America is first. Now, I know what you're thinking. You're thinking this is just political theater, that we've seen government shutdowns before, that they always work it out at the last minute. And normally, you would be right. But this is not a normal situation. Let me explain why this government shutdown is fundamentally different from every other shutdown in American history, and why it's the catalyst that's going to send silver to $200 in the very near term. When the government shuts down on Friday night at midnight, which is now absolutely guaranteed to happen, something unprecedented is going to occur. The data agencies are going to go dark. The Bureau of Labor Statistics, the people who publish the inflation numbers that the Federal Reserve uses to make every single monetary policy decision, will close their doors. The Bureau of Economic Analysis, the people who tell us whether we're in a recession, will send their workers home. There will be no CPI report. There will be no jobs numbers. There will be no GDP data. The entire economic radar system that the Federal Reserve uses to fly the airplane of monetary policy will go completely black. Now imagine you're Jerome Powell, you're the chairman of the Federal Reserve, and you're already losing control of the bond market. Treasury yields are spiking, banks are showing signs of stress, the repo market, the plumbing of the financial system, is starting to freeze up. And suddenly you're told that you have to manage all of this with zero data for the next 3 to 4 weeks. You don't know if inflation is accelerating or decelerating. You don't know if unemployment is rising. You don't know if consumer spending is collapsing. You're flying completely blind in the middle of a Category 5 hurricane. What do? Do you sit tight and do nothing while the system potentially melts down around you? That's dangerous. Do you raise interest rates to combat inflation you can't measure and risk crashing an economy you can't see? That's suicide. No, when a central bank flies blind, they default to their most primal institutional instinct, which is to panic. And the only tool they have when they're panicking and can't see the data is to flood the system with liquidity. They print money. They inject reserves. They launch what I call a safety print to keep the gears lubricated while they're operating in the dark. They will choose inflation over the risk of a deflationary collapse every single time. And here's the critical point that most people are missing. The market knows this. The hedge funds know this. The sovereign wealth funds in Singapore and Dubai know this. They understand that a data blackout forces the Fed into a defensive money printing posture. This is why gold hit a new all-time high this morning at $5,080 per ounce. This is why silver smashed through $110 and shows no signs of slowing down. The smart money is not waiting for the Fed to actually start printing. They're front-running the inevitable response. They're buying the anti-dollar assets now because they know that by next week, the dollar is going to be diluted by a panicked Federal Reserve trying to navigate a political crisis they can't even measure. But the government shutdown is only one part of the equation. What happened in Minneapolis over the weekend has turned this from a financial crisis into a social crisis, and that changes everything. For those of you who haven't been following the news because the mainstream media is deliberately suppressing this story, let me bring you up to speed. In the last 72 hours, there have been 2 separate incidents involving federal agents shooting civilians in Minneapolis. The second incident, which occurred late Saturday night, involved a 34-year-old ICU nurse who was walking home from a 12-hour shift at the hospital. She was unarmed, she posed no threat, and she was shot by federal agents conducting what they called a routine patrol. The video of this incident went viral within hours, and the public reaction has been unlike anything I've seen in my career covering financial markets and social dynamics. This is not just anger. This is a visceral, collective rage that's spreading across the country at a speed that's frankly terrifying. Minneapolis is burning right now. Not figuratively, literally burning. The National Guard has been mobilized, protests have spread to Chicago, Detroit, and Milwaukee, and this social chaos has completely destroyed any chance of a budget compromise in Washington. The Senate Democrats have drawn a line in the sand. They're saying they will not sign any funding bill that includes money for federal enforcement operations. The Republicans are saying they won't sign any bill that defunds those operations. It's a complete deadlock driven not by fiscal policy, but by moral outrage. And when politics becomes emotional rather than transactional, compromise becomes impossible. This guarantees the shutdown. It guarantees the data blackout. And it guarantees that the Federal Reserve is going to be forced to print money in the dark. Now here's where this directly impacts the silver market and why anyone telling you to sell at $110 is either ignorant or malicious. When you combine a financial crisis with social unrest, you create the perfect storm for precious metals. Investors look at their screens and see the banks in trouble. They look out their windows and see cities burning. Where do they put their money? Do they buy stocks in companies whose stores are being looted? No. Do they buy bonds from a government that's shooting nurses in the street? Absolutely not. They buy the only assets that are neutral, private, and don't depend on any government or institution to maintain their value. They buy gold and they buy silver. This is why premiums on physical silver have absolutely exploded over the last 48 hours. I checked with multiple dealers this morning, and if you want to actually buy a physical silver eagle right now, you're paying $128 to $135 per ounce depending on quantity. That's a $20 to $25 premium over the spot price. And that premium is widening, not narrowing. This tells you everything you need to know about the real supply and demand situation. The paper price on the COMEX might say $112, but in the real world where actual metal changes hands, silver is trading closer to $130. And that spread is going to get wider, not smaller, as this crisis deepens. Let me address something directly because I'm seeing a lot of confusion and frankly a lot of fear-mongering in the precious metals community right now. There are people, some of them with large platforms, who are telling you that silver is overbought, that the technical indicators are showing extreme levels, that a correction is inevitable and you should sell now to lock in your gains. These people are using traditional technical analysis tools like the relative strength index, moving averages, and Bollinger Bands to make their case. And in a normal market environment, they might have a point, but this is not a normal market environment. This is a currency crisis masquerading as a silver rally. Here's what these technical analysts fundamentally don't understand. Overbought does not mean overvalued. These are 2 completely different concepts. Overbought simply means the price has risen rapidly and is trading above its recent historical range. It's a momentum indicator, nothing more. Overvalued means the price is higher than the fundamental value of the asset justifies. And based on every fundamental metric that actually matters, supply deficits, industrial demand, monetary debasement, geopolitical chaos, silver is not overvalued at $110. In fact, it's still dramatically undervalued. Let me give you some data to prove this point. The annual mine supply of silver is approximately 800 million ounces. Total annual demand, including industrial use, investment demand, jewelry, and now increasingly sovereign accumulation, is running at about 1.2 billion ounces. That's a structural deficit of 400 million ounces per year, a 33% shortfall that has to be filled from somewhere. For years, that deficit was covered by above-ground stockpiles, recycled silver from electronics and old coins, and central bank sales. But those buffers are now exhausted. The vaults are empty. The recycled silver is being consumed as fast as it comes to market. There is no longer a cushion of inventory waiting to be sold into price rallies. When you have demand exceeding supply by 33% and that gap cannot be filled from existing inventories, basic economics tells you that price has to rise until one of 2 things happens. Either demand is destroyed because the price gets so high that marginal buyers drop out, or new supply is incentivized because mining becomes profitable at higher price levels. At 110 per ounce, we are nowhere near demand destruction. Industrial users like Samsung, Tesla, and solar panel manufacturers are still buying every ounce they can get because there is no substitute for silver in their applications. Investment demand is actually accelerating as more people wake up to the currency crisis, and sovereign nations are now treating silver as a strategic monetary asset that must be accumulated regardless of price. So the only way to balance this market is through new supply. And here's the problem. The incentive price for developing new primary silver mines after you factor in exploration, permitting, construction, and all the capital costs is estimated to be between $150 and $200 per ounce. And even if silver hits $200 tomorrow and mining companies immediately greenlight new projects, it takes a minimum of 5 to 7 years to bring a new mine from discovery to production. So even in the best case scenario, new supply won't hit the market until 2031 at the earliest. We have a structural supply deficit that cannot be solved in the short to medium term, and the only mechanism that can ration available supply among competing buyers is price. Now let me show you something that should completely destroy the argument that silver is overbought and due for a major correction. I want you to look at the velocity of this move, because velocity tells you everything about the strength and sustainability of a trend. I've been tracking a metric called time to travel, which measures how many days it takes for silver to move $10 in price. And the data is absolutely conclusive. The move is accelerating, not decelerating. When silver went from $20 to $30, it took 145 days. That was a grind. The banks fought every inch. Then when we moved from $40 to $50, it took 39 days. The resistance was weakening. When we went from $70 to $80, it took only 6 days. And the move from $90 to $100 took 10 days. Now look at what just happened. We went from $100 to $110 in less than 3 days. Do you see the pattern? 145 days, 39 days, 6 days, 10 days, 3 days. This is exponential acceleration. This is not a move that's running out of steam. This is a move that's entering the vertical phase. And here's why this velocity pattern is so important. In traditional technical analysis, when an asset goes parabolic, you expect a sharp correction as profit takers sell and the move exhausts itself. But silver is not a normal asset. Silver is what economists call a Giffen good during a currency crisis. A Giffen good is a rare phenomenon where demand actually increases as price rises. Why? Because people see the rising price and interpret it as confirmation that the currency is dying. The higher silver goes, the more panic it creates, and the more desperately people want to own it. It becomes a self-reinforcing feedback loop. At $20 per ounce, buying silver was an investment decision. At $110 per ounce, buying silver is a survival decision. The psychology has fundamentally shifted from greed to fear, and fear is a much, much more powerful motivator than greed. This is why you're seeing billionaires, sovereign wealth funds, and institutional investors paying massive premiums to acquire physical metal right now. They're not trying to make a profit. They're trying to preserve wealth through what they see coming. Let me share some additional data that proves we're in the early stages of this move, not the late stages. Bank of America, one of the most conservative major financial institutions in the world, just published research forecasting gold to hit $6,000 per ounce by spring of 2026. That's 8 to 12 weeks from now. And in that same report, they specifically addressed silver and mentioned that based on historical gold to silver ratios, silver could reach levels that most people today would consider absurd. They cited the 1980 ratio low of 14 to 1, which at current gold prices would put silver at $355 per ounce. Now, Bank of America didn't explicitly forecast 355 silver because that would cause panic in the markets and probably get them investigated by regulators. But they put the data right there in black and white for anyone with eyes to see. And this is coming from a mainstream Wall Street bank, not some fringe newsletter or conspiracy theorist. When the most conservative institutions are starting to publish research that implies triple-digit silver in the near term, we're not in a bubble. We're in a revaluation. But here's what really confirms that $110 is nowhere near the top. Look at what's happening in the physical market right now, particularly in Asia. Chinese recyclers are currently offering to buy silver from the public at $112 per ounce, VAT exempt. That means ordinary Chinese citizens can walk into a recycling center right now and sell their silver for $112 cash, which is essentially the spot price. But in the Shenzhen Shuibei gold market, one of the largest physical precious metals markets in the world, silver is trading at the equivalent of $128 per ounce when you include the VAT tax. Think about what that means. There's a $16 spread between what recyclers are paying and what retail buyers are paying in the same city. That spread exists because demand is so intense that recyclers are immediately flipping everything they buy to desperate retail buyers at massive markups. And it's not just China. I'm receiving reports from dealers in India, Singapore, Dubai, and across Asia that physical silver is essentially unavailable at any price close to spot. The arbitrage opportunity is massive. You could theoretically buy silver on the COMEX at $112, take physical delivery, ship it to Shanghai, and sell it for $128. That's a $16 profit per ounce with minimal risk. And you know what? That's exactly what's happening. Large institutions are doing precisely this trade, and they're draining the Western vaults in the process. This is what I call the Great Silver Drain, a one-way flow of metal from west to east that is irreversible and accelerating. Keith Neumeyer, the CEO of First Majestic Silver, one of the largest primary silver miners in the world, revealed something shocking on a podcast last week. He said that for the first time in his 23-year career running silver mines, he's receiving direct calls from buyers in Asia asking to purchase silver straight from the mine, bypassing all traditional distribution channels. These buyers don't want to deal with the COMEX. They don't want to go through the LBMA in London. They want to buy physical metal directly from the source and have it shipped immediately to vaults in Shanghai or Singapore. This tells you everything about the trust, or lack thereof, in the Western paper markets. Now let me address the manipulation argument, because this is something I hear constantly. People say, Asian guy, the banks are manipulating the price, they're going to smash it down, they always do, that's why I should sell now and buy back lower. And look, I understand where this thinking comes from. For decades, there was clear evidence of price suppression in the precious metals markets. Banks were caught spoofing, layering fake orders to trigger algorithmic selling. JP Morgan paid nearly $1 billion in fines for manipulating the gold and silver markets. This is documented fact, not conspiracy theory. But here's what people don't understand. That manipulation only worked in a low volatility, low demand environment. When silver was trading in a narrow range between $15 and $25, when investment demand was minimal, when central banks were selling rather than buying, the big banks could control the price with relatively small amounts of capital. They could dump a few $100 million of paper contracts at strategic times and trigger cascading stop losses that would crash the price. But that world no longer exists. The amount of capital required to suppress the silver price at $110 with this level of physical demand is orders of magnitude larger than what it cost at $25. And more importantly, every time they try to smash it down, the physical buyers step in and absorb everything. We saw this happen 3 times last week. On Tuesday, Wednesday, and Friday, there were coordinated paper dumps at the New York Open designed to trigger panic selling. Each time, the price dropped $3 to $5 within minutes. And each time, within 2 hours, the price was back above where it started. The physical bid is simply too strong. The manipulators are running out of ammunition. The COMEX warehouse inventories are at historic lows. The number of ounces eligible for delivery is a fraction of the open interest in futures contracts. We're approaching a situation where if even a modest percentage of contract holders stand for delivery, the exchange will default. And when that happens, and it's not a matter of if, but when, the paper price and the physical price will diverge permanently. Paper silver will trade at a massive discount to physical because everyone will realize the paper is worthless. It's just a promise that can't be kept. Let me give you a framework for understanding what's happening and where we're going. We are currently in phase 2 of a 4-phase monetary transition. Phase 1 was the awakening, when a small group of informed investors started accumulating precious metals as the debt situation became untenable. That phase ran from about 2020 to 2024. We're now in phase 2, which I call the acceleration phase. This is where the price starts moving fast enough that mainstream investors begin to notice. This is where financial media starts covering the story. This is where premiums start expanding and physical shortages begin to appear. We're right in the middle of phase 2 right now. Phase 3, which I believe we'll enter within the next 30 to 60 days, is what I call the scramble phase. This is where the COMEX defaults on delivery. This is where sovereign nations panic and start competing directly with each other to acquire whatever metal is available. This is where you see $200, $300, $400 silver. This is where premiums explode to 50% or more over spot. This is where governments implement export bans and potentially even confiscation schemes. Phase 3 is chaos. Phase 4 is the reset. This is where the IMF, the BIS, and the major central banks announce a new global monetary framework with some form of commodity backing. The dollar gets officially devalued by 60 to 80%. A new trade settlement system emerges, probably centered around the BRICS nations and their commodity basket currency. Anyone holding physical gold and silver sees their wealth multiply several times over in purchasing power terms. Anyone holding dollars, bonds, or other paper assets sees their wealth evaporate. Based on current trajectories, I believe we're about 60 to 90 days away from entering phase 3. The government shutdown that begins on Friday is the catalyst. The data blackout forces the Fed to print blindly. The printing accelerates the loss of confidence in the dollar. The The loss of confidence drives more capital into hard assets. It's a self-reinforcing spiral that ends with a complete restructuring of the global monetary system. So when someone tells you to sell your silver at $110 because it's overbought, what they're really telling you is to exit your position right before phase 3 begins. They're telling you to sell the only asset that's going to preserve your wealth through the greatest currency crisis in modern history. And whether they realize it or not, they're acting as an agent of the system that's trying to separate you from your protection. Let me be very direct about what I think you should do, although this is not financial advice and you need to make your own decisions based on your own circumstances. If you own physical silver right now, do not sell it. I don't care if the price goes to $150 and you see a massive unrealized gain. Do not sell your physical metal for dollars. The dollars are becoming worthless. The metal is becoming money. You would be trading real wealth for paper that's being printed into oblivion. The only time you should consider selling silver is if you need to exchange it for another hard asset like productive land, tools, equipment, or essential supplies, or if you need to use it directly to purchase goods and services in an environment where the traditional banking system is no longer functioning. But selling silver for dollars with the intention of buying back lower is a fool's game right now. You might get lucky and catch a dip. But far more likely, you'll sell at $110, watch it go to $130 while you're waiting for a pullback that never comes, then panic buy back in at $140 and end up with fewer ounces than you started with. If you don't own any physical silver yet and you're thinking about buying, my advice is to acquire whatever you can get your hands on immediately, even if you have to pay elevated premiums. Yes, paying $130 for silver that shows a spot price of $112 feels expensive. But in 6 months, when silver is trading at $250 and physical premiums are 60% over spot, you're going to wish you had paid $130 today. The window for acquiring physical metal at any reasonable price is closing rapidly. And please understand the difference between paper silver and physical silver. Do not buy SLV or any other silver ETF thinking you're getting exposure to this move. Those are paper derivatives. When the COMEX defaults and the system breaks, those paper claims are going to be settled in cash at whatever price the powers that be decide is fair, and it won't be fair. You need to own actual metal in your actual possession or in a segregated allocated account at a private vault that's not affiliated with any bank. Let me address the security issue because this is becoming increasingly important as the crisis deepens. If you own a significant amount of precious metals, you are now a target, not just from common criminals, but potentially from your own government. We have historical precedent for this. In 1933, Franklin Roosevelt signed Executive Order 6102, making it illegal for Americans to own gold. The government forced everyone to turn in their gold at $20.67 per ounce, then immediately revalued it to $35, confiscating 40% of the wealth of every gold holder. Could this happen again with silver? Absolutely. Once we get deep enough into phase 3 and governments become desperate for hard assets to back their failing currencies, confiscation becomes very possible. This is why you need a multi-layered security and storage strategy. Do not keep all your metal in one location. Diversify across multiple secure sites. Some at home in a well-hidden safe that's bolted to the foundation, some in private vault facilities that are not affiliated with banks and preferably not in your home jurisdiction, and if you have substantial holdings, some in international vaults in jurisdictions that your home government cannot easily access. Singapore, Switzerland, and certain Caribbean nations are popular choices for this, though I'm not specifically recommending any particular location. And whatever you do, do not advertise the fact that you own precious metals. Don't post pictures of your stack on social media. Don't brag to friends and neighbors. Don't wear silver jewelry that screams, "I'm a precious metals investor." The fewer people who know about your holdings, the safer you are. In a real crisis, which is what we're heading into, the people who quietly accumulated and stored their wealth properly will be fine. The people who were loud about it will become targets. Now let me give you my specific outlook for the next 7 days, because this is the critical window. We are exactly 5 days away from the government shutdown. Every day that we get closer without a deal, the probability of a deal drops exponentially. At this point, with Minneapolis burning and both political parties dug into positions they cannot retreat from without losing their base, the shutdown is essentially guaranteed. Friday at midnight, the lights go out, the data agencies close, and the Fed enters blind flight mode. I expect Monday, which is today as I record this, to be extremely volatile. We've already seen silver gap up from $100 to $110 in the Asian session, and I would not be surprised to see it touch $115 or even $120 before the week is out. But I also expect the manipulators to make at least 1 or 2 more desperate attempts to smash the price. If you see a sudden $5 or $7 drop in a matter of minutes, do not panic. That's not a real seller, that's a desperate short covering operation or a last-ditch attempt to shake out weak hands before the real move begins. Every single dip in the last month has been bought aggressively within hours. The physical bid is too strong. By Wednesday or Thursday, as it becomes clear that no budget deal is possible, I expect to see the VIX, the fear index, spike dramatically. When that happens, algorithmic selling will hit the stock market hard. Money will flow out of equities and into safe havens. Gold and silver will catch a massive bid. This is when I think we could see silver break $125 and possibly even approach $130. And then Friday night at midnight, when the shutdown actually happens and the reality of the data blackout sets in, I think we could see gap-up opens in Asia Sunday night that takes silver to $140 or beyond. I'm not saying this will definitely happen. Markets are unpredictable. But based on the fundamentals, the technical momentum, and the macro backdrop, a move to $140 by next weekend is entirely plausible. The most important thing I can tell you is this: hold your silver. Do not let short-term volatility shake you out of your position. Do not listen to the talking heads on CNBC who are telling you to sell. They've been wrong about precious metals for years. They were wrong when they said gold would never break $2,000. They were wrong when they said silver would never break $30. They were wrong when they said $50 was the top. And they're wrong now when they're saying $110 is the top. The fundamentals are screaming that silver is going much higher. The supply deficit is structural and cannot be solved quickly. Industrial demand is insatiable. Investment demand is accelerating. Sovereign accumulation is increasing. The dollar is being debased through reckless money printing. The geopolitical order is collapsing. The banking system is showing signs of severe stress. And we're about to enter a period where the Federal Reserve has to manage all of this without being able to see any economic data. Every single one of these factors is bullish for silver. Not one of them has reversed. Not one of them shows any sign of reversing. In fact, they're all intensifying. So why on earth would you sell? The answer is you wouldn't, unless you don't understand what's happening, or unless you're listening to people who either don't understand or who have a vested interest in you selling. The next stop for silver is $200. Not $200 as a long-term target, $200 as a near-term objective that we could hit within the next 60 to 90 days. And $200 is not the top either. Based on the supply deficit, based on the historical gold to silver ratio, based on the currency debasement we're witnessing, silver could easily reach $300 to $400 before this cycle is complete. And if we get a true COMEX default and a complete loss of confidence in the paper markets, the sky is literally the limit because physical silver will trade at whatever price is necessary to entice current holders to sell. So my message to you is simple. Stay calm. Hold your silver. Ignore the noise. Ignore the fearmongers. Ignore the people telling you this is the top. They're wrong. They've always been wrong, and they're going to continue being wrong as silver marches toward $200 and beyond. The fundamentals are on your side. The momentum is on your side, and most importantly, reality is on your side. The system is breaking, the currency is dying, and the only people who are going to preserve their wealth through what's coming are the people who had the courage to hold real assets when everyone else was panicking. This is not the time to sell. This is the time to hold. This is the time to be strong. This is the time to trust the process and trust the fundamentals, because everything we predicted is happening exactly as we said it would. Silver broke $100. Silver broke $110. And silver is going to break $200. The only question is whether you'll still be holding when it does. Hold strong, stay calm, and I'll see you on the other side of $200.